Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 27th, 2024. How you doing? I appreciate you coming by and watching the podcast today. I hope you're going to find it helpful and learn something. And boy, what a week in the markets. Big rotation out of tech and into the mid caps, IWM, and into the Dow. Um, uh, Later on in the podcast, I'm going to break down the indexes as well. But really, the format for today's podcast, as normal, is first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week and the positions that I made last week, both on the daily time frames and the weekly time frames. Going to talk about when I entered, why I entered, what were the signals, what were the confluences of signals that occurred for me to enter the trade and the setup, and then most importantly, how I am going to manage the trade going forward, whether it goes my way or goes against me, where I place my emergency stops, where I place my end of day stops, where I'm taking partial profits, serious resistance levels that I'm looking at as well. But it's been a good trading week. I was fortunate enough to stay out of a lot of the down moves. And so very grateful for that. Always grateful when I have good trades. But I hope by taking a look at these trades and seeing what my thinking was of why I enter and how I'm going to manage the trades, I hope that's going to be helpful for you. And if it is, I would appreciate it if you could hit the thumbs up button. It really does help out the channel and lets YouTube know there's some valuable content. After that, we're going to talk a little bit about trader psychology, and most important part and the most important skill in trading is the ability, really, when you boil it down, is the ability to create a plan and then to follow that plan. There's lots of different plans out there, lots of different processes. Whether it's something you learn from me or from someone else, it's totally fine. But what it really comes down to is being patient, waiting for a certain support level or entry trigger to occur. And if you're right, having the ability to have an outsized gain if you're right, but if you're wrong and being wrong quick and being wrong small. That's really what it is. So, that's in general, that's your basic trading plan. But the ability to follow that plan, that's where things become tricky. So I do like to talk about trader psychology and what it takes to follow your plan. So I hope you'll find that helpful. After that, I have gone down through my master watch list, and I have identified some potential trades that I'm looking for next week on the daily time frames. I looked on the weeklies, but out of all the stocks that I look at, I didn't find anything really that's interesting on the weekend, which is kind of interesting in itself. But I did find some, about 10 of them on the daily time frames that I'm looking for a potential entry next week. They're not where they need to be at the moment. And that's the key. On the weekends, I go through and I go, okay, XYZ stock, it's here right now. But if it got there sometime next week, then I may be interested in taking the trade. And that's the part of looking at all the different stocks, looking in the future where if they got to a particular level would be interesting, and then sitting on your hands and waiting and not entering until it gets to that level. If it doesn't get to that level, then fine, I just don't enter. But if it does get to that level, then it's a potential entry, depending on what the price action is, depending what it does. So I have gone through, and I'll share with you what I'm looking at for my trades next week. All right, so that's kind of the plan for today. I'm going to go ahead and run the U.S. legal disclaimer, and when that's finished, we'll get started. So hang tight for about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. So, kind of off topic, I've been watching my neighbor's dogs for the last week while they've been on vacation. Holy smokes. Oh my gosh. It has been like a circus over here. I've got one that's a Malinois, Penny. I've known her since she was a puppy. She's real easy, but I have this little dog that's part Australian Shepherd and part Corgi. So really long, short and long. Oh my gosh, and she's like a year old. She is just full of it, man. I'll tell you, it's been like a circus around here. They're climbing all over me on my head at all moments of the day while I'm trading. It's been interesting for sure. Okay, well, let's get started. First trade, really great trade, short trade I had on silver, SLV. And the setup for this one is called an abandoned baby. That's right here in the red. And one of my new favorite approaches that I use are either abandoned babies or island reversals. And if you'd like to learn more about them, I have a YouTube video on it. Just go to my YouTube channel, go to the lessons playlist, and look for abandoned babies island reversals. So this worked out really well. You can see this highlighted red area here. What is that? Well, the day before, do you see how we gapped up? So from the previous day's close to the open, it gapped up. So for whatever reason it was, the market liked it and was very bullish on silver. But however, the next day it gaps down. So it went from very bullish quickly to very bearish. And when these sharp and sudden moves happen, where everything's great one day and negative the next day or bearish the next day, this is telling you something. Now, it doesn't always immediately have to go down, but if you have a bearish abandoned baby, if you look at it in the future, more than likely it will be lower later. Same with bullish ones. Here's a bullish one right here. And you can see see how it gapped down? So it went from very bearish gap down to immediately gapping up. That was bullish. And look, it was bullish, wasn't it? Okay, so when so here it gapped up, gapped down. Now, I could have gotten short here. I didn't. When I get abandoned babies island reversals, I like for the gap to be closed first. So we gap up, we gap down. And I like it to come up to the bottom of the bearish abandoned baby. So we gap up, we gap down. I waited for the price to come up and test the bottom, in this case, because it's bearish, of the abandoned baby. So as soon as it got there, this happened 2 days later, I got short at 28.48 because it came to the bottom of the abandoned baby. Now, I could have just certainly got short here and it would have worked out just fine as well. But oftentimes when you have these abandoned babies or island reversals, you gap up, you gap down, and then it tends to want to rally for a minute before you have the leg down. And that's exactly what happened. So I got short on that day, 28.48. It did close a little higher than where I entered. So I was down on the trade for a little while. So on these abandoned babies island reversals, I make the profit and the stop loss very, very simple. What I do is because this is a short trade, I take my entry price and I add 2 ATRs to it. That is going to be my stop. Now, my profit target, I want to have minimum of 2 times my loss. So I have a 2 ATR stop. So what I want to do is put a profit target 4 ATR. So it's twice what I'm risking. Okay, so I put my profit target 4 ATRs down here. Now, one of two things is going to happen when I put on this trade, and it makes it quite easy. Either I am going to lose 2 ATRs or I'm going to make 4 ATRs. And in my trading and what I've discovered on these particular type of trades, they're not always correct, right? And a bearish abandoned baby doesn't always go down. But what I have found is that almost 70% of the time, when you take a valid abandoned baby, I'm going to hit my 4 ATR profit target. 30% of the time, I am going to hit my 2 ATR stop. So that's pretty good. Now, that's been my experience. It doesn't mean it always has to happen in the future. But if 70% of the time I'm making twice as much as I'm losing, that's pretty good, right? That's pretty good. So this is the trade. I got short here again because we had the bearish abandoned baby, and then we rallied back up to the bottom of the abandoned baby. Got short 28.48, placed my stop up here 2 ATRs below, above, and then my profit target 4 ATRs below. And immediately worked. Went down, went down, went down. Wednesday, I thought to myself, ooh, we're getting pretty close to my profit target. And then Thursday, look at this. It gapped all the way down. So I got more profit than I was expecting. Now, keep in mind, this can go against you. I can place my 2 ATR stop up here and it can gap up above it, and I can lose more than 2 ATRs. Okay, so it cuts both ways. But this is called positive slippage. I told the system, hey, if it gets here, take the profit. But because it opened up lower, I got an even better price. So that was a really, really great trade from entry to where I exited. And I exited right there at the low, 12.87% on that trade. But again, they don't always work. But the key is when they work, you make twice as much as if you're wrong and you lose. So anyway, check out that video of mine. I think you'll like it. I really like abandoned babies and island reversals. And like I said, they're quite simple. You know, one of two things is going to happen. I'm going to lose 2 ATRs or I'm going to make 4 ATRs. And in this case, I guess I made 6 ATRs. So that was really good. So great trade on that. I am out and flat on silver for a 2.87% gain. Oil. Okay, USO. Okay, so this is a different type of setup. It's not an abandoned baby, anything like that. This is what is called a bearish order block. So what is an order block? Well, let me take you back to this bar here on the 1st of July. This was the highest up bar close before we had a market structure change. And a market structure change came, there's two types of market structures. One, we have the trend line here, broke the trend line, and the way that I look at this changes market structure to the downside. And also here on this day, the 16th, we took out this swing low. That also changes. This is ITC stuff, and it is really valuable, and that's why I've started using it and teaching it. You can check out ICT on video as well. So the point is that when you're in an uptrend and you break structure to the downtrend, once you break structure to the downtrend, I want to look to short rallies. The opposite side of that is if you're in a downtrend and you break market structure to the upside, then I want to look to buy dips. You've heard the old saying, buy dips in an uptrend, sell rips in a downtrend. Well, this is selling rips in a downtrend. Downtrend because one, we broke the trend line to the downside. Two, we took out this swing this day here on the 16th. We took out this swing low. That also puts it into what I consider a downtrend. So I want to short rallies back up into the order block. The order block is here on the 1st. The low was 79.82. The high was 81.69. So anywhere in this red area is the shortable area. Now, you can approach this many different ways. You can just approach it by whenever it gets into the red area, get out. That's one option. I like to be a little bit more technical about it, and the reason I got short on this trade was a V1. Here we go. But keep in mind, first of all, we're in the bearish order block. So really anything in here is shortable. But if I want to be a little bit more tactical about it, I use the V1. Here's the V1 that I took on the 18th of July. Bar 1, bar 2. bar 2 goes above bar 1's high, closes below bar 1's low. There's also things called V2s, which consist of 3 bars. And I use V1s and V2s all the time in my trading. If you'd like to learn more about those, again, in my YouTube channel in the playlist, there's a video called V1s, V2s, and I go into a lot more detail of what they are. So I got short here at 79.89 because of the V1 in the bearish order block. Now, when I get short, I immediately put my emergency stop 2 ATRs above my entry. So that's my worst case scenario. Now on a V1 or a V2, I have an end of bar stop, which is halfway of the washout bar of the V1. I call it the washout because it went above and closed below. So essentially, my stop was any close above 80.33. So emergency stop 2 ATRs above my end of bar stop on a V1 or a V2 is simply a close above 80.33. I want to have that very close. So I got short here 79.89. Remember, if I just closed above 80.83, I'd be out of the trade. You know, I'm gonna hit this emergency stop only about 5% of the time. 95% of the time, if I have a loss, it's going to be because my end of bar stop. But fortunately, none of that happened. So as soon as I saw the entry, placed my emergency stop, know where my end of bar stop is, the next thing I do is I calculate 1.5 ATRs below my entry. That's trailing stop mode. And if I ever get there, then I go into what's called trailing stop mode. Okay, now all of these things, the end of bar stop, the emergency bar stop, the trailing stop level, these are defensive moves. It's if it hits my emergency stop, obviously I get out. That's a defensive. If I hits my end of bar stop, that's defensive. Why is my trailing stop level defensive? It just means that because now I'm in trailing stop mode, if I get a close above the previous bar's high, then I exit half my position. So it's something that's going against me. But I also like to play offense, and I play offense by taking partial profits on my positions if the price moves the value of 0.45 ATRs from the previous bar's close. So let's just take it to current day right here. The previous bar's close 76.11. The value right now, the 0.45 ATR, is 65 cents. So I'll take 76.11 minus 65. That will be my first profit target on Monday. Now I place 3 profit targets each day. Then I'll take my first profit target minus 65 from it. That will be my second profit target. Take my second profit target minus 65. That will be my third profit target. Okay, so when I entered the trade here on the 18th, the next day it went down substantially, didn't it? So I took off. I hit 2 profit targets, and each profit target I take 10% off of whatever shares I have going into the day. So 10% of whatever shares I have going into the day, whatever's remaining, 10%. So on this particular day, I hit 2 profit targets. I may have hit 3. I can't remember. So why do I do that? Well, I take advantage of the move that's happening, and it reduces my position size, right? Locks in those profits. Market can't take that away from me anymore. Reduces my position size so that if it does reverse against me, it mitigates it. So got to trailing stop, trailing stop. Now, if I have a close above a previous bar's close, I'm going to get out of half. Well, it hasn't happened yet. Next day went down, took some more profit targets. Next day went down, took some more profit targets. Remember, I'm in trailing stop mode, so any close above a previous bar's close, I get out of half. Here on the 25th, it almost closed above, but it did not, so it kept me in the trade. And then on Friday, moved down again, took more profit targets. Now, currently we're at a 39.20 RSI level. If I get to the point where I get to a 35 RSI level, now this 5 EMA will come in as a trailing stop. So I do have all sorts of rules. And if this is new to you, you may think, oh, those are a lot of rules. How would I ever remember that? The thing is, it's not that hard. I've been trading for 29 years. And every single rule I have, there is an absolute reason. And so, this might be a good time to bring up that I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course where I teach you all the different approaches I use, all the rules, and when you're done with that course, you will know the rules. You know them like the back of your hand. And, like I said, all of these rules are in here for a reason. They're to make more money or to lose less money. And, so if you would like to work with me, if you'd like to study with me, and have me teach you step by step how to trade all these, it'd be great to have you as a student. My email is in the link of this description. Just reach out to me, and we'll have a Skype call, get to know each other a little bit, and then after that, if you decide you want to do it, then great. But it's a great investment, and it's great to learn this skill. So USO now, like I said, if it gets to a 35 RSI level and then closes back above the 5 EMA, I'm completely out of the trade because I'm in trailing stop mode. If I have a close above previous bar's close, I'll lock in half of the remaining shares that I have. But this has been a really good short trade from entry to current price now, up 5% in about a week. So that's pretty dang good. So that's USO. Let's go to WBA. WBA, again, is a different approach that I use. It's good to have different approaches, everyone. It really is. So WBA is Walgreens. I did get long Walgreens on the 22nd of July. I got long here, 11.29. Why? Well, this is called the deep dip buy approach of an under 30 over 30. But more importantly, it's a higher low under 30 over 30. We went under 30 over here, and then we lost it. And then on this particular day, we went under 30 over 30 at a higher level. In addition to that, we had a double bottom with a bullish MACD divergence. Look at this low here, deep red MACD bars. This low here, not quite an equal low, but very close. No red bars whatsoever. What does this mean? It means from a MACD perspective that we're running out of selling momentum. And if you run out of selling momentum, the implication is that you're going to, if you run out of sellers, essentially the implication is you're going to go up, but you still have to wait for the signal. So an under 30 over 30 plus a V1 to the upside. Look, bar 1, bar 2. Bar 2 goes under bar 1's low, close above bar 1's close. So I got long here 11.29. Now, my emergency stop, as always, 2 ATRs below. My end of bar stop, half a close below halfway of the washout bar, which is 11.04. So you see how close I am on my stop if I'm wrong. Here's my trailing stop level up here. And then for the next couple days, it kind of moved sideways, didn't do anything. Thursday moved up. I did take some profits on the Thursday move up. And then Friday, it also moved up, and I hit one profit target. So starting to scale out, not in trailing stop mode yet, but so far a pretty good trade. And this particular trade up 4.8% last week. So pretty good, pretty dang good. All right, ARC. ARC is a position that I took, a short position that I took on Friday. Why did I take it? Well, let's take a look here. Look at the trend line. We broke the trend line. So the way that I look at that, we are in a downtrend. As soon as we broke the trend line, it does what it often does and rallies, and then failed, and then moved down. But take a look at the 200-day moving average, the black line here. This is what I keyed my trade off of. We came down, we came up. Thursday, tried to go above it, failed. Friday, tried to go above it, failed. And so this offers me a very good risk to reward ratio. So I entered short with the rejection of the 200 at 45.72. I placed my emergency stop 2 ATRs above. My end of bar stop is simply any close above this 200-day moving average, the black line. So Friday or Monday, if it just closes 1 penny above the 200, I'm out for a very small loss, right? I mean, it may close higher than that, but this is right now, this 200-day moving average is, hey, sorry, everyone, the dogs, is the resistance above the 200-day moving average. So it's resistance. So it's more likely to go down than up because it has that kind of ceiling above it. But the main part is here is that the market is in a bearish market structure. It it has not been able to get above the 200, and if it does and just closes above, I'll simply get out. That's all there is to it. I have my worst case scenario here with the 2 ATR above. This orange line here, this is my trailing stop level. So if it moves down and gets to this level, then I go into trailing stop mode. And profit target wise, look, 45.78 is the closing price, minus 59 cents. If that happens on Monday, that's my first profit target. So I know where my first one is, my second one, my third one. So this one pretty much break even. I'm down on it just a little bit. I got short 45.72. It's 45.78. So very small, just call it break even at this point. So I am short ARC. And then TLT. Okay, so if you listen to the podcast last week, I was talking about some kind of rejection of the 200-day moving average. This is the black line. And I pointed out the gray line here crossing over the black line. What that means is the 50 SMA is closing over the 200-day. And what I mentioned was whenever I see that's called the golden cross, whenever the 50 crosses over the 200, the first move or the first rejection of the 200-day moving average is usually a pretty good bounce area. So this bar closed below the 200, so that's off the table. But on Thursday, we closed back above the 200. And you see how close we are to the 200? That sets up a good potential risk to reward with the support of the 200 below me. So I got in on Thursday at 92.27. I placed my emergency stop 2 ATRs below. My end of bar stop, simply a close above the 200-day moving average. My trailing stop level 1.5 ATRs above. So I got long here Thursday 92.72, and then Friday moved up nicely. Did hit one profit target, which is great. So that reduces my overall position size. That profit target I took, the market can't take that away from me. And currently, right now, this particular trade up 0.80% one day. Not bad. Okay, so that those are the trades. Silver, the short up 12.87. I did close that out. USO up 5.01. WBA up 4.48%. ARC slightly down, almost break even. TLT up 0.8%. Oh, I forgot about UNG. Okay, UNG. I am out of this trade. It was a monster trade, and let me take you through this. So I got short UNG back here on the 12th of June at $20.82. Again, why? Well, we have a break of the trend line. That puts us into a downtrend. We broke this pivot point. That also puts us into a downtrend. So I want to short any rallies. Well, take a look at the 200-day moving average here, the black line. Similar to that, like I just showed you on ARC, and similar that I just showed you on TLT. Look, on this particular day, we went above the 200 and below the 200. I got short 2082, placed my emergency stop 2 ATRs above. End of bar stop, just simply a close above the 200. If I'm wrong, place my trailing stop level down here. We moved down, took profits. Moved down here, took profits, got to trailing stop level. After reaching trailing stop level, it closed above a previous bar's high. I exited half the position for a gain of 4.82%. Then it just moved down and down and down. And as it's moving down, I'm taking partial profits, taking partial profits, taking partial profits, taking partial profits. On the 18th, we went under 30, over 30. That one of my rules is if I'm short and that happens, I'm going to take off half of the position. So I took off the remaining half of the position for a gain of 47.11%. Amazing. The next, to get rid of the rest of the position after rejecting the 30 RSI, if I have a close above a previous bar's close, I'm going to do that. And that happened on the 22nd, where I exited the full amount of the trade. I exited everything of the trade for a gain of 38.76%. So this was a massive short trade. They don't always work out this way, but sooner or later you will get one. And the key is having the fortitude and knowing your process and staying in. I mean, look, I could have gotten out here and going, oh, that was a great trade, I'm out, but I kept with my process. So exited the remaining shares for a gain of 38.76%, and it's down even further from there, but that's okay. That was a monster trade. So those are all the daily trades. Let me take you to the weekly trade here on McDonald's. This is a weekly trade, but this particular trade, even though it's a weekly trade, I did enter it on the daily. And why? Well, the black line here is the weekly. I felt like there may be some support there. So I drew the line of the weekly 200 here, the black line. I went to the daily time frame, and I saw on the daily that it did go below the 200 week moving average and closed above it. That was good enough for me. I got in at 245.90. Now, I'm not managing it on the daily. I'm managing it on the weekly, but I just took the trade on the daily to get, and I did get in at a little bit better price at 245.90. So it did move up on the weekly to my trailing stop level. So now I am in trailing stop mode on the weekly. So my emergency stop is, of course, 2 ATRs below. My end of bar stop is a close below the 200-day or 200-week moving average. And but it did not close below the low. So that kept me in the trade. So this particular trade up 2.64%. Now, I don't hold through earnings. Earnings are next week. So before earnings come out, I'm going to exit the trade, whether it's at a gain or a loss at the moment. So those are the trades on the daily and the weekly. It was unbelievable week, really great week, both long and short with a variety of different approaches, which is important. You know, the way that I look at trading, it's important to trade as many different strategies as you can, trade as many different time frames as you can, and trade as many different types of markets as you can, not just stocks. I mean, let's look at the trades I had. Silver, metal, gold, not gold, oil, right? So we have metals, we have oils, we're long stock, we're short stock, we're long bonds. I was short natural gas and then long stock. So a nice variety of different markets, different strategies, both short and long. And so that's what I think is very important in trading. So anyway, I hope that was helpful. All right, so before we get to the potential trades for next week, let's start with a little bit of trading psychology. This is from my good friend Steve Burns. This is the New Traders, Rich Traders channel on Facebook. You can follow them there. You can also follow Steve at S Joseph Burns on X. Check that out. Really great channel. So let's see what Steve has to say here. I remember I responded to this text because I felt strongly about this, but don't expect to be a profitable trader without suffering through the process of figuring it out. It's very important on multiple levels. There's a process that you're going to go through of figuring it out. But what I responded to this post was, you have to go through the process of finding your process. Some people are very good at long-term trading. They can hold on to trades for a long time. Other people, that doesn't work for them. They can still be profitable traders, but they have to have quicker trades because they're not good at holding on to things. It's fine. Nothing wrong with that. There is a process out there that will fit your personality and your psychology better than others. And that's the key, finding that trading approach that works for your personality. And the other process, and that's the process of finding what your process is. And it's very important to have a process, or in other words, to have a plan, a trade plan. If this trade does this, I'm going to do that. If this trade does that, I am going to do this. It's extremely important, everyone. It really is, to find that process that helps you. And whether you learn it from me or you learn it from someone else or it's something that you come up with, it's totally fine. But the key components of any process are being patient, waiting for a support level, knowing exactly what your risk is, and having that risk not be too far away so that if you're wrong, you can be wrong small, and if you're right, you can be right big, like on the UNG short trade. I mean, my risk to reward on that was, I don't know, 50 to 1. That was, I mean, I was risking my end of bar stop was, I don't know, a quarter of a percent away, and I close out those trades there in the 30% and 40% range. Unbelievable. That's a perfect example of having a good risk to reward ratio. So being patient, waiting for a major support level that you can key your trade off. If you're right, you have a potential for outside gain. If you're wrong, you're wrong small. That's it. So don't expect to be a profitable trader without suffering through the process of figuring it out. And again, like I said, the process of figuring out is the process of figuring out what your process is. Okay? Thank you, Steve. Appreciate that. And figure out your process and stick with that process. That's really what it comes down to. All right. So let's look at the potential trades that I have next week. Now, usually I have dailies and weeklies, but today I just have dailies. I didn't find any on the weeklies, which kind of goes to show you something, right? Of the 80 stocks or whatever that I look at, nothing looked good on the weeklies. Nothing. It doesn't happen very often, but it goes to show you need to be patient, wait for a good setup, and if it's not good setup, then just move on and don't do it, right? And so here I have 10 potential trades that I'm looking for next week. Now, theoretically, all 10 of these setups could happen on the same day. Does that mean I would take 10 new positions on that day? No. If all of these happen to trigger on Monday, I would only take one. That's a rule that I have for myself. I only take the best trade of that day. So how do I know what the best trade is? Well, if one of them, for example, rejects the 200-day moving average, is that a legitimate trade? It is. But maybe there's another one that rejects the 200-day moving average and also has a V1. That one would be better than the previous one. Maybe one has a bullish MACD divergence and a V1 and a rejection of the 200. Well, that one would be better. So each thing that it has, I give it a score. If it has one thing, I give it 1 point. If it has two things, I give it 2 points. 3, 4, 5. If one has 5 and the other has 1, which one do you think I'm going to take? I'm going to take the one that has the highest score, the best report card. And so, and there's many things that I look at. How many multiple confluences of entry signals, which one looks best on multiple time frames, which one has the best market strength, relative market strength or weakness, depending if I'm looking for a long or a short. And I factor this all into my decision. And again, this is what I will teach you in my one-on-one course. The devil's in the details. How to pick the best trade of the day based on multiple things. And that's why I think my trading course is really so beneficial. And I have taught people from all over the world, from absolute beginners to seasoned hedge fund managers and everywhere in between. So if you really would like to learn how to trade the way that I do and how to look at things, and someone that's had 29 years of experience and that loves to teach, I'm your guy. Just send me an email and we'll get the conversation started. The the cost of the course is $1,750, but I promise you, it is worth every penny. It's worth 10 times that, honestly, really. I have people say, why do you charge such a small amount? And I was like, well, you know, there are a lot of small traders that I would like to help that if it was a lot more expensive, it just would be out of their price range. So anyway, let's get started. Adobe. Okay, so Adobe's not where it needs to be, but like some of the similar trades I showed you before, take a look at the trend line. We broke the trend line. This, in my opinion, puts it into a bearish market structure. We also took out this swing low, so that also puts it into a market structure. So now, the way that I look at it, we are in a downtrend. What do I want to do in downtrends? I want to short rallies in a downtrend. Well, look, here is the highest bar close before the market structure change. So therefore, this is the order block between 568.23 and 560.23. This is the red highlighted area here. If it gets back into this area, it's a potential short for me. Now again, if it bounced off the bottom of if it rejected the bottom of the order block, I might enter there. If it keeps going, maybe I don't do anything until it rejects the top of the order block. Or maybe I have a reverse, bearish V1 or V2 in the order block like I did with with oil, excuse me. So it's not so simple of when to enter. You can make it very simple and just go, look, as soon as it gets to the order block, I'm in. That's totally fine. But I think we can do better than that by looking for some other price action. So if I do get short, then obviously I'll place my emergency stop 2 ATRs above. And my end of bar stop will simply be a close above this swing high here at, what is that? 570.10. Because if it takes that out and goes above that, then that negates the bearish structure and would put it back up into a bullish structure, right? So again, broke the trend line to the downside, broke the pivot point to the downside in a bearish. If I get a bounce up here into this area somewhere here and it's the right price action, I may consider to get short. Maybe there's something else that day that looks better, like I just mentioned, has a higher score, has a higher quality trade score. So that's what I'm looking for, a potential short Adobe next week, somewhere in the red box. AGQ. All right, AGQ is double leverage silver. Now, a couple different potentials here to get long. First potential is if we come down to the 200-day moving average. This is the black line here. And this is a deep dip buy approach. And there's three major moving averages here. The 200-day moving average, the 250-day moving average, the 300-day moving average. These are all deep dip buy areas. Also the 30 RSI. And some of the best confluences you can get, everyone, is a rejection of a major moving average. At the same time, you have an under 30, over 30 on the RSI. And if we get down to the 200-day moving average, we will have that or be very close to having it. But I want to see a rejection of the 200-day moving average and ideally also an under 30, over 30. So that's one approach. That's a very good risk to reward setup. It doesn't mean it's going to be a profitable trade, but it's having a very distinct line in the sand, and if it closes under 200, I'm out. That's it, right? So a lot of potential confluences on silver if we come lower. Alternatively, Monday, if we gap up, then that will create a bullish island reversal. But we have to gap up on Monday or Tuesday or Wednesday. And then you would have these a gap down, move sideways, 2, 3, however many bars, and then a gap up. That would create a bullish island reversal. And at that point, I would get long as well. And if I got long on an island reversal or a abandoned baby, 2 ATR stop 4 ATR profit target, just like I showed you on silver. And let me just show you, kind of going back in the past here. Here we go. This is a bearish island reversal. Gaps up, 1 day sideways, gaps down. That was a shortable area. Did that work? Sure did. Bullish, abandoned baby. Gap down, gap up. Did that work? Sure did. Bearish, abandoned baby. Gap up, gap down. Did that work? It did. See the power of those things? They don't always work, but they work more. So that's why I'm saying if we go down, fine, and rejects the 200-day moving average, potential long trade there. However, if we gap up and create this bullish island reversal, that would also get me potentially long as well. Make sense? So either needs to gap up, bullish island reversal, or gap down, not gap down, or go down and reject the 200-day moving average. And so either way, I have a feeling I'll be taking a trade on AGQ one way or another next week because a lot of good confluences happening here. Excuse me. Okay, CCL, Carnival Cruise Line. Okay, so you can see the 200-day moving average down here. It dovetails with the 250-day, dovetails with the 300-day. They're all nesting together here in this green area box. This will be a very decent place to potentially get long Carnival Cruise Lines. Now, let's look back in the past. Was the 200-day respected? It certainly was, and it turned into a really nice potential great trade. If you're looking for a moving average to see whether or not it is going to be respected, look in the past and see if it was the last time, and it was. It doesn't mean it has to be rejected. It doesn't mean it's going to work this time, but it's more likely if the previous time it was respected that it will respect again. Don't know. But look, it's quite a long ways away. It's at 1572. We're at 1727. May not get there at all. It may just take off or take forever. But this is the point I'm trying to make. Identify the level. I do it on the weekends. Identify the level that would make sense to you and say, okay, if it gets there, that makes sense. And if it makes sense, I may take the trade. Gives me a good risk to reward ratio. If it never gets there, then fine. I'm just not going to mess with it here unless it gets to where I want it to. Guess what I'm saying is just wait until something gets to where you want it to. Of course, you have to know where you want it to is, what it means, why that's an area, but it's very simple. You have the major moving averages down here. All right, so if and only if Carnival Cruise Line gets down here to these 200, 300, and 250-day moving average levels, then I just won't mess with it. But if it does and it comes down and rejects it, does a deep dip buy, then, gives me a good structure for the trade. Stays over the 200, I'm in. And scale as it moves up. If it closes below the 200, I'm out. Hits my emergency stop, I'm out. It's very simple. Gold. Okay, so gold, just like the trade that I had on silver, look, we have a bullish we have a bullish abandoned baby on gold. Thursday we gap down. Boom. No, Wednesday, yes. Thursday we gap down. Friday we gap up. That is a bullish abandoned baby. Did I take the trade? I didn't. Again, when these bullish abandoned babies happen, oftentimes they'll come back to the top of the abandoned baby. That's why I drew the line there at 219.26. Yeah, I could have gotten long on Friday. It's fine. Really, it's fine. But I didn't. I just want to see a little bit of a pullback to the top of that abandoned baby. There's going to be a lot of support there. It doesn't have to be, but oftentimes there is. So if gold gets back to 219.26, then I'll potentially get long. This is an abandoned baby, so I'll place a 2 ATR a stop and a 4 ATR profit target. And again, if you go back on GLD and just in the recent past, look, exactly the same. Look, gap down, gap up. Did that work? Sure did. You have a bearish island reversal. Gap up, down. Did that work? It did decently. And so again, this looks bullish for gold. You know, if I look out to the future, I would say, hey, more than likely, if we look at this next week, it probably will be higher. It may not. I could just go straight down, but I'm just talking percentage wise. If I had to bet one way or another, is it going to be higher or lower next week? I would say higher, but I have to have, you know, certain levels in to go, okay, well, I say higher, but if I'm wrong, I have to bring wrong small. And if I'm right, I can have, twice what I was risking. So I guess what I'm saying is this doesn't have to be higher next week. But if somebody put a gun to my head and said higher or lower, I'd say probably higher because of the bullish abandoned baby. So I'll wait to see if it comes back, test the high of that at 219.26, potentially take the trade. Google. Okay, well, here we go. So Google has had a major liquidation. And let's take a look here. This was kind of foretold by the technicals. Take a look at the trend line. We broke the trend line. Once we broke the trend line, we checked back up into the bearish order gap and we failed. But more importantly, look, when you break a trend line to the downside, that trend line that was once support for you is going to be resistance. And look what happened. Broke the trend line, came back up, literally touched the trend line. Literally touched it, and straight down. So the reason I'm mentioning this is in just a little bit when we take a look at the indexes, there's something similar that, I want to point out. So huge, major drop in Google. Now, Google did have a legitimate entry signal on Friday that I missed. And the entry signal is a deep dip buy, an under 30, over 30 intraday. So intraday it was under 30, closed back above 30. Okay, that by itself is legitimate. I like to have more than one or two. But this doesn't happen very often. And what happened was we had an under 30, over 30 at the same time we had a rejection of the 100-day moving average. This is the red line. So it doesn't mean this has to go straight up, but all it means is that you had a confluence of signals. You had an under 30, over 30 at the same time you had a rejection of the 100-day moving average. You've heard me talk about under 30, over 30s with the rejection of a 200. Yeah, great. That's great. But to have an under 30, over 30 at the same time you have a rejection of the 100, you have to have a major down move, and that's exactly what happened. So I didn't take the trade on Friday. I'll just have to see what it looks like on Monday. I mean, this stock is on sale. Most people people love to buy sales except for when they're stocks. They like to pay full retail price for some reason because the news is good, the sentiment's good. It's difficult to go against the grain and buy when it seems like everyone's selling. But on a company like Google, Apple, these kind of things, historically, doing that has paid a lot. So I will just have to see next week. The reason I highlighted this was not that that it is a setup, not that I took it, but I'm highlighting it because the rare under 30, over 30 in rejection of the 100-day moving average confluence happens. So I'll just have to see. I'll just have to see what happens. I guess selfishly, for me, I'd like to see it go back under 30 RSI and then back over 30 RSI, giving me a higher low under 30, over 30 RSI. But if someone took this trade on Friday, if it was me, then if it closed below the 30 RSI, that's when I would have gotten out because that's really why I took it under 30, over 30. So I'll just have to watch that. All right, Meta. All right, so we have earnings coming up, and I would love to buy Meta at the 200-day moving average. I don't know if it's going to get there. We have earnings, and on earnings, it could go way below the 200-day moving average, or it could skyrocket. Not sure. But either way, I'm not going to get involved with it like right before earnings because what's the what's the reason to do that? I'd have to get right out. So I guess what I'm really kind of saying here is, for some reason, if earnings disappoint and we come down and reject the 200-day moving average, I may consider taking the trade. Or if it goes lower and rejects the 250-day, I may take that. Or if it goes lower and rejects the 300-day moving average, I may take that as well. So again, not going to get involved right before earnings, but I am going to be watching the 200, the 250, and the 300 after earnings in case it goes down as a good entry level to get into. Microsoft. Okay, same. 200-day moving average here. It's hard for me to believe that we were up in this high 70 RSIs, and now I'm talking about buying at the 200-day moving average. Pretty historic, but it does happen. And again, we have earnings next week. So after earnings come in, if we reject the 200-day moving average, I could potentially get long there. NVIDIA, okay. NVIDIA has gone down substantially. Some clues of the top were these big reversal bars, huge reversal bars. When you're in this massive kind of uptrend and you get a huge reversal bar like this, it's telling you something. We went down, the first dip was bought, we got to about halfway and failed. Okay, so anyway, that's done and that's over and done with. So let's talk about, what would be a decent location to potentially enter NVIDIA. Well, there's a big fair value gap, bullish fair value gap here in this green box. Somewhere in this green box would be possibly a decent place to potentially get long NVIDIA. The only question is where. The absolute ideal place for me would be here at $95.81. Well, that's, 18 points away. So I don't know if we're going to get there. If we did, very likely I would get long, because this previous resistance here that we broke out of strongly, that previous resistance becomes support. So 95.81 would be an excellent place to get there. However, it may not get there, but it may come into the bullish fair value gap, maybe have a V1 or a V2 to the upside. The top of the fair value gap's dovetailing pretty nicely with the 100-day moving average. That's the red line. So a lot of potentials on NVIDIA. So I will be watching. I guess I should put it this way. If we bounce off the top of the bullish fair value gap, then we would most likely also reject the 100-day moving average. If we reject that, I would potentially get long at the 100 and use the 100 as my stop. If we come deeper into the bullish fair value gap, the green box, and then have a V1, I potentially get long there. And thirdly, like I mentioned, if we come down and reject the bottom of this previous resistance here, 95.81, if that happened, I would almost certainly get long. And my stop would just be a close below the low of this swing low here on the 17th of 91.70. So all sorts of different potentials, but in my experience and opinion, anywhere within this green box would be a decent place to potentially get long NVIDIA, as long as you have a good, where your stops are. Tesla's been very strong up until the last 2 weeks, but the real obvious place for me to potentially buy Tesla is here at the 200-day moving average. I mean, we raced all the way through it. Now we've come back down to it. The 200, the black line, dovetails almost exactly with where the 50-day moving average is. That's why I've had the green box here. But that would be an absolute decent place to get long Tesla. But I would first need to see a rejection of that 200-day moving average, either a close under, close over, a bounce, or an intraday rejection. Doesn't mean it's going to be a profitable trade, but it gives you a very distinct line in the sand. If it's over the 200, I'm staying in. If it's under the 200, I'm out. But you see everyone that chased these trades up here, you Yeah, it's fun when it does this, but really when you get up into these areas here, if you don't get out quickly, it could be weeks or months or years to get back up to this price. So, that's why I never buy stuff. I buy stuff in the value zone and want to sell above the value zone, or I buy stuff below the value zone and want to sell in the value zone. I never, ever, ever chase these things up here because this is what happen. So always have those levels, always know when you're in, you're out. And for Tesla, just very simple. 200-day moving average. If it rejects it, I'm in. As long as it stays above, closes below, I'm out. Last but not least is United Airlines, UAL. Okay, pretty easy. Look, black line, 200-day moving average. This is what was respected last time, right? Tested it, moved up. I don't know if it's going to come back down to the 200-day moving average. It may just head up, and if it does, great. But if it does come back down and test the 200-day moving average, then that would be an interesting spot for me to get long. So, all right, I want to talk a little bit about the indexes. So let's look at the Qs. So if we look at the Qs here, this was a long-term trend line here. See the bottom here, bottom here. We extend those out into time. Well, on Wednesday, we lost it. Okay, we lost the trend line, which it wasn't strong enough to stay above it. What I'm pointing out here is now this trend line that used to be support is resistance above us. And so next week, if we rally, in my opinion, there's two areas where you're going to have resistance levels. One would be this red line here, horizontal red line, big down bar. If we get to halfway of it, very likely there's going to be some resistance there. Alternatively, if we go back up and bounce higher and get to that trend line, now that trend line, again, before it was support, now it's resistance above. So watch those levels. I mean, the biggest rallies that you have are in bear markets. And, next week we have earnings, next week we have PAL. So a lot of things that could really move the market. But keep in mind, this trend line above the Qs here very likely is going to act as some resistance. So I don't know if we're going to go straight down and straight up like we usually do. There's a lot of resistance here. So I'm not, keep those levels in mind. And then on the SPY is a little different. Here's the trend line here. We broke that trend line. Longer term trend line, we almost got to the penny and the market respected it. You see that? And in addition to that, we bounced off that trend line. Also, we recovered the 50-day moving average, which is important. So we bounced at this trend line. We've recaptured this trend line. But to the upside, we still have this particular trend line above us that was support. See how it bounced right there? And then we lost it. So even the SPY, even though the SPY is stronger than the Qs, if we get back up to this trend line, more than likely that is going to act as some kind of resistance above. So look, we've changed market structure to the downside. We've lost trend lines. We've busted through pivot points. We've made lower highs and lower lows. We are in a downtrend. And that's what I mentioned to you last week. I said, look, everybody on the Qs, I said, hate to say it, but we are in a downtrend. And it's been a while since we've been in a downtrend, but we are in a downtrend on the Qs. So, and look what happened last week. It continued to the downtrend. So those are the areas that I'm looking for on SPY, is if we get back to that long-term trend line there, it's resistance above us. All right. So, and take a look at the VIX. The VIX, very dormant, sleepy, nothing, 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 and then a huge explosion. So there is volatility in the market, everyone. And, whether we go straight on up, I guess it's possible. I think it's unlikely. Of course, Powell is kind of the trump card there. If if they cut rates, not expected, but if they do cut rates, then I would expect the market to get a rally from that. So please be careful. We are in a downtrend, at least on the SPY and the Qs. However, if you look at the Dow, look, look at the trend line here. You see how we came down almost Thursday and touched it to the penny? The Dow is in an uptrend. We have not changed market structure. We have not lost trend lines. Same with IWM. If we go to IWM, we are in a bullish market structure as well. So the money is rotating out of the SPY, it's rotating out of the Qs, it's going into the IWM, it's going into the Dow. They're getting a little pricey here as well. So I guess what I'm saying is please be careful. So, hey, I've mentioned a couple times teaching private one-on-one lessons. Love to have you as a student. All you have to do is send me an email, teach you everything I know, teach you step by step. When you're done, you're going to be a much better trader. I'm sure of that. Number two, I also have an online video course, Deep Dip Buy. We talked a lot today about deep dip buys. I have an online course at udemy.com. That link is in the description of that video. The course is 9.5 hours. It costs somewhere between $30 and $50, so it's very affordable, and you're going to learn a lot step by step how to trade that deep dip buy approach. And then also during the week, a few times during the week, I'll do a short video on some of my day trades where I use these same approaches just on a smaller time frame. So look for those. I think you'll like those. And again, if you like the video today, if it was helpful, I really would appreciate you hitting the thumbs up button. It really helps out the channel. And last but not least, please try to go out and do something nice for someone today. You know, it's nice when somebody helps you out, right? Nice random act of kindness. You know how it feels good, right? Why not do that to someone else? Try to do one random act of kindness a day and to a human, and then if you could also do something nice for an animal, they would appreciate that as well. So I appreciate you being here. I hope you're doing well. Please be safe out there in that crazy market, and God willing, I will see you next week. But if you have any comments or questions on anything I mentioned today, just put them in the comment section and I'll do my best to reply. All right, everybody, thanks a lot for your time. Appreciate you spending your time here, and have a good rest of your weekend. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.